Good evening, ladies and gentlemen. On behalf of my colleagues at Bankruptcy Commission and our friends at Saudi Central Bank, SEMA, and our partners at King & Spalding, we are honored to welcome you in this symposium. In an effort to raise the effectiveness of the bankruptcy procedures and enable the law, as well as implement its provisions, we would like to start our symposium today titled Saudi Arabian Bankruptcy Law, Current, the Trends and the Future Development. We welcome our speakers today, Mr. Abdullah Al-Anizi, the Division Director of the Banking Policies in the Department of Banking Policy of the Control Agency at SEMA, Mr. Mike Rainey, Partner at King & Spalding, Mr. Zaid Al-Farsi, Partner at King & Spalding, Mr. Simon Rahimzada, Partner at King & Spalding, Mr. Jonathan Jordan, Counsel at King & Spalding. Our dearest audience, we are happy to receive your questions and inquiry in English through the Q&A button down below. And now I would like to call on Mr. Abdullah Al-Anizi to present his paper.
السلام عليكم. حياكم الله جميعا. بداية أشارك زملائي في لجنة الإفلاس الترحيب بالجميع في هذه الندوة تهدف إلى تسليط الضوء على الاتجاهات الحالية والتطورات المستقبلية في نظام الإفلاس. بلا شك والكل يعلم أهمية نظام الإفلاس تكمن في تعزيز ثقة المستثمرين المحليين والدوليين بتمكين إعادة التنظيم المالي للمنشآت المتعثرة لتجاوز مرحلة التعثر المالي وسداد الديون والالتزامات. يؤمن البنك المركزي بأهمية تكامل الجهات مع بعضها البعض لنجاح منظومة الإفلاس وبدوره الهام في هذا الشأن. وكان ولا يزال مشارك للجهات الأخرى في دعم هذه المنظومة. هنا في مستهل هذه الندوة أود أن أذكر وعلى عجالة أبرز ما قام به البنك المركزي من مساهمات ودور في هذا الشأن، مع التأكيد بالطبع استمرار البنك المركزي في دعم هذه المنظومة. أولاً، وجه البنك المركزي كافة البنوك والمصارف التعاون مع أمناء الإفلاس وتمكينهم من الاطلاع على التعاملات البنكية الخاصة بالمدين عند إجراء إعادة التنظيم المالي وإجراء التصفية، وذلك بعد التحقق من الصلاحيات الممنوحة لأمين الإفلاس بموجب الحكم القضائي الصادر من المحكمة المختصة. كما أنه أوجد متطلبات موحدة بين البنوك والمصارف لفتح الحسابات البنكية بغرض إيداع حصيلة بيع أصول التفليسة الضامنة لدين المدين الخاضع لإجراء إعادة التنظيم المالي. طبعا يمكن هذا الإجراء تم مؤخرا ولكنه في غاية الأهمية، والمؤكد أن هذه المتطلبات محددة على وجه الدقة والبنوك ملزمة بفتحها خلال يوم عمل واحد فقط دعما لتسهيل إجراءات فتح الحسابات البنكية. علاوة على ما سبق، أكد البنك المركزي على البنوك والمصارف وجوب تعليق المطالبات تجاه المدين وعدم اتخاذ أي إجراء أو تصرف تجاهه أو أصوله حال تلقي البنك عن طريق أمين الإفلاس أو وسائل التبليغ الرسمية حكما بتعليق المطالبات. ويشمل ذلك الإجراءات المبنية على الأحكام والقرارات الصادرة من محاكم التنفيذ والمحاكم المختصة كقرار الخصم والتحويل. وأؤكد في هذا الصدد أن البنك المركزي يتابع التزام البنوك في هذه التعليمات بشكل مستمر، ويرصد التجربة العملية للبنوك في هذا الشأن ومعالجة أي تجاوزات قد تقع في هذا الشأن. هذا باختصار، لن أطيل عليكم، أترك للزملاء في اللجنة إدارة الندوة. أتمنى أن تكون ندوة موفقة وشكرا للجميع.
Thank you so much, Mr. Abdullah. I would like to remind the audience that there's an Arabic interpretation of the symposium, and you can switch the language by pressing on the language icon below and choosing the German option, so you can hear the Arabic interpreter. And now I would like to call on Mr. Mike Rainey to present his presentation.
Thank you very much. Thank you. Great. I hope you can all see the screen. So my name, for those of you who don't know, yeah, great. And for those of you who don't know me, my name is Mike Rainey. I'm a finance partner at King & Spalding, working with borrowers and lenders in connection with their financing requirements, including consensual and non-consensual restructurings. For those of you who don't know King & Spalding, we're a 130-year-old law firm, head offices in Atlanta, Georgia, in the USA, but we have an international footprint, so we cover Asia, Europe, obviously the US, and also the Middle East. And in the Middle East, we operate out of offices in Dubai and Abu Dhabi and have an affiliation with the law offices of Mohammed Al Amar in Riyadh. And we're a full service firm, save for tax, working with debtors and creditors following the implementation of the bankruptcy law in Saudi in 2018, which obviously is the topic of our presentation today. I'm joined today by two colleagues, Zaid Al-Farisi and John Jordan, and I'm just going to get them to very briefly introduce themselves, starting with Zaid.
Thanks, Mike. Good afternoon, everyone. My name is Zaid Al-Farisi. Like Mike, I'm also a finance partner at King & Spalding, and I cover the full range of financings, both borrower, sponsor, and lender side, and also restructurings.
Thanks, Zaid. And John?
Thank you. My name is John Jordan. I'm a counsel in the Atlanta office of King & Spalding. Thank you for allowing me to be here. I've been practicing bankruptcy law for nearly 30 years on all sides of insolvency cases. I've worked for a variety of secured and unsecured creditors, debtors, buyers, trustees, committees, and parties to litigation. In early 2019, Mike called me up to talk about the KSA bankruptcy law. We talked about some of the similarities between US and Saudi laws and ways that some of the practices in the United States, United Kingdom, and other countries can work to benefit distressed companies and their creditors in the kingdom. Of course, not everything that works in the United States will translate perfectly to the business and legal environment of Saudi Arabia, but we hope to present you with a perspective that you can consider, and in the right circumstances, some of them hopefully will benefit the administration of bankrupt businesses.
That's great. Thanks, John. So our topic today, current trends and future developments in connection with the Saudi bankruptcy law. So as Saudi and the world generally moves on from COVID, bankruptcy and insolvency laws are going to play an important role. So the fact that the Saudi bankruptcy law has been implemented nearly 3 years ago now, and also lots of practical examples of cases being brought to the courts, that's going to be very beneficial to Saudi, to stakeholders when we, as I say, as we emerge from COVID. I think a number of businesses will be distressed, and having a robust insolvency law is certainly going to help those businesses navigate their way back to good health. And from our perspective, we, as practitioners, we know that businesses which struggle financially, the management time is taken up with dealing with the financial distress, and having a bank that's lent to you, also at the bank, management time is taken up, working with distressed borrowers. And the more efficient the bankruptcy law is in order to deal with distressed situations, to the extent that they can be dealt with, we view that as a good thing. And that's what the idea today is, that we will talk to you about what we've seen in the market over the last 2 or 3 years, and some ideas about how that might be improved, or how things could be made more efficient. So starting with current trends, I want to make the general observation that most of you who are in the audience today will be familiar with this, but one of the most common, and we think probably the most common bankruptcy procedure that debtors, and for that matter creditors, have turned to is the financial reorganization procedure, also known as FRP. And that's not unsurprising. And one of the main reasons it's not unsurprising is because by making an application which, if accepted, and you go into the process, you get the advantage of a moratorium, and that a moratorium applies not only to the debtor, but also to anyone, any guarantors, so anyone who's guaranteed the debt of the debtor. So that's very, very helpful. But of course, entering the process and getting the moratorium is only the start of the process. And of course, the moratorium is for a limited amount of time. I mean, the purpose of the moratorium is to enable the debtor a period of time to put together a restructuring plan, which not only needs to be approved by the court and the bankruptcy trustee, but of course also any affected creditors. And so I've just mentioned that the some time limits on the moratorium, and Zaid, I want to ask you a couple of questions, and just for the purpose of the audience, I'm going to be overseeing or running the presentation, but I'm going to be bringing in Zaid and John to answer various questions, so there'll be a little bit of dialogue. And as was mentioned at the beginning, please also send us your questions, because we can spend some time at the end of the presentation going through those. So Zaid, starting with the moratorium, maybe just start out, when the law first came in, was there a time period for the moratorium? I think the answer is no, but then some guidance came in around time periods, and what we're seeing in the market around whether that's long enough, in particular given COVID, whether we need to be thinking about extending that moratorium period.
Sure, Mike, happy to do so, yeah. So by way of background, as Mike mentioned, when the law initially came into effect in August of 2018, there wasn't a specific timeline for the expiry of the moratorium in the cases of FRPs, financial reorganization procedures, unlike, for example, the case for preventative compositions. And on the 4th of March 2020, a royal decree was issued, a royal order instituting a timeline for moratoriums in relation to FRPs. And effectively, it was an initial 180 period that can be extended based on the request of the trustee or the debtor for a further 180, so that it was a maximum of 360 in total. And as probably everyone can expect, this was introduced at the time when it wasn't apparent probably that we'll be going through this tough pandemic that we are presently going through. And between that, effectively, the pandemic and many of the, let's say, very challenging cases that we're going through an ambitious system, but still a nation system. The bankruptcy law, as Mike mentioned, we're now in the 3rd year. Last year, of course, would have been in the 2nd year. And the result of this, we've seen certain cases where we're working on, where effectively the 360 days have expired, and the moratorium, based on that, would no longer be in effect. But it can't go away, otherwise the system wouldn't work, right? So you need the moratorium so that the procedure can succeed. And we've seen courts react to this. So we've seen various instances where the court would grant 3 months, an additional 4 months, 5 months, 6 months, effectively primarily because of the COVID and the delays that are associated with that, but to ensure that the moratorium can extend a little bit further so that the procedure can be completed in a proper way.
Yeah, and I think this is an interesting point, because we have had 1 or 2 occasions, and I mean, obviously, I think it'll be on a case-by-case basis. Maybe it's not right to make a general rule that the moratorium should, say, be extended for 2 years for the next, say, 3 years to enable restructurings to be implemented because of COVID delays. I think the idea of having a limited moratorium period is probably a good one, because it focuses the mind. It means that you have to get on with the job. It means you have to get this restructuring plan up and running and approved. having an extended period, may mean that things can lag and drag on. But I do think that COVID definitely, impacted some of the restructurings we've been working on, and we on several occasions have had to go to court and ask for extensions. But I think if you are asking for an extension, you better make sure that you're asking for an extension because you've been prevented from doing something because of COVID, not because you've sat on your hands and haven't moved things forward as quickly and efficiently as you can. So that's it.
Yeah, and maybe I would just add for the lawyers on the call, as you may appreciate, there's always this, I wouldn't necessarily say tension, but sometimes a bit of a choice between absolute rules and discretion, and particularly say for judges, and where do you draw the balance? And as Mike said, and particularly in the context of regulations relating to insolvency, it is important to have timelines that people can adhere to so that the system works efficiently. And maybe in this case, you have a rule such as this with some discretion for a judge on an ad hoc basis where an extension is required based on the court's judgment to ensure that the process can be completed sensibly, and which is what we've seen de facto happening, right? Judges are doing that. So maybe that will then be institutionalized at some point.
Yeah, and it's a good point, Zaid. And I think it's a general theme that runs through the law as well, that you don't want to have a rigid approach because that's, generally speaking, that's not how good law works. You want the ability of, in particular, the courts and the bankruptcy trustees to be able to exercise some form of judgment because every case is different. And as capacity builds up within the courts and the bankruptcy trustees, and what I mean by that is experience, because this is a new law, and we're learning all of the time. But as we build capacity, experience, I think we'll be more confident about being able to exercise judgment and saying, look, in this circumstances, we think we need a little bit more time. In that circumstance, look, you've had enough time. The moratorium ends. So I think an element of discretion is important. The next trend that we want to talk about, so we've spoken about FRPs. That tends to be what we're most commonly involved with. But in relation to, what do these restructuring plans look like? For the most part, what we're seeing, and again, this is just a general comment, is that we're seeing really debt reprofiling is what we're seeing. And what I mean by that is that, taking a very simple example of a debtor which may have relationships with banks, and it may have, so when I say relationships, I mean it's borrowed money from banks, so it's got banks as creditors, and it's also got suppliers, and maybe it's got employees who are creditors. So you've got two lots of creditors, and what we're seeing is that the banks, generally speaking, are reluctant to write down their debt. They may well have had to make provision for it, so they may have accounted for a write down of the debt on their books, but they're generally speaking not prepared to write that or take a haircut, as we sometimes call it. So they will extend the repayment terms of the financing. So whereas it may have been a 5-year term, maybe that's extended out to 8 or 9 years, but they expect to get repaid in full. And then with the unsecured creditors like suppliers, sometimes they're prepared to take a haircut, so they may accept 60% of what they're owed, but generally they will be paid in a shorter amount of time, maybe 3, 4, 5 years. So that's, we're seeing quite a lot of that. Now, one of the issues that we potentially see with that is that you leave a debtor with over indebted. So reprofiling may leave debtor with excess debt, making its life difficult going forward, which it could include, defaulting on repaying that debt. But it's probably a handbrake or a handbrake on raising new equity. And John, I just wanted to get your initial thoughts on issues that may arise on debt reprofiling. We're going to talk a little bit about this in future trends because this is where it comes to this balance again. I mean, you've got a borrower that's over indebted, well, you may say, well, that's your fault. You should have never borrowed so much money. And therefore, the creditors are fully entitled to say, we're not going to write any of this down. So there needs to be a balance, doesn't there? And that's what the law's about. We want to see, debtors which who have become over indebted, due to, for whatever reasons, generally speaking, the commercial decisions have been made, which in hindsight, may have not have been the best commercial decisions, or we've had COVID. There's a variety of reasons that the debt that's been taken on may not be able to be repaid. So we've got to get a balance as to, what do we do with this debtor? Do we just liquidate it, or do we, try and ensure that we put the debt or the indebtedness of this debtor in a position where it can survive and go forward. So maybe John, just mention a couple of things on debt reprofiling as opposed to extinguishing debt, for example.
Sure, Mike, as you pointed out, one of the goals of any reorganization, whether in court or out of court, is to adjust the debtor's balance sheet. In the case of a bankruptcy, we have to balance the need for creditors to be repaid as close to in full as we can make them against the debtor's need to emerge from bankruptcy with a fair chance to succeed. Because the approval of a reorganization proposal under both US and Saudi law depends, among other things, on significant creditor agreement, there's a danger that creditors will err on the side of saddling the debtor with too much debt after bankruptcy so that it emerges over-leveraged. In the United States, we jokingly refer to Chapter 22 cases. That is, when a company files a Chapter 11 reorganization bankruptcy, emerges, and then in a few years it has to file another Chapter 11 case because it's kept too much debt. Retailers such as Kmart, Smith Corona, Radio Shack, those are just a few of the large companies that did not properly estimate the amount of debt they could carry in the future. In some of these cases, a sale to a strategic buyer may be a better outcome than having a secured lender end up owning the company, because the motive of a lender who holds a company and the motive of a player in the industry are very different. And sometimes the person who ends up owning the company is either better or less equipped to deal with the amount of debt and navigate the business environment.
Okay, yeah, thanks, John. So, look, we make the point a lot. We do see a lot of debt reprofiling, but there are storing up potential issues if we do that, and we can talk a little bit about that later in the presentation. The other interesting thing, again, this is just an observation, is a limited secondary market for non-performing loans. So if a bank does have a non-performing loan or a portfolio of non-performing loans, we don't often see those loans being transferred off, or the bank deciding, well, I'm going to now sell these loans to someone else who can, at a discount, and that someone else can then work through the loan. And Zaid, maybe we can just touch on one or two of the reasons why, we don't, in our view, why we don't see a strong secondary market for non-performing loans.
Sure, Mike. You had mentioned the tendency of Saudi banks not wanting to realize a loss and kind of holding on to these loans, which is maybe a small part of the story. What I would say the bigger part certainly would be what I would generally call as regulatory reasons. Chief among these is the banking control law, which effectively limits the ability of non-licensed entities to engage in banking activities. Broad term, obviously, banking activities, but I'll just maybe summarize by saying there's an open question as to whether lending or let's say purchasing a distressed debt from let's say a licensed lender, whether that would qualify as engaging in banking activity or not. And I would also add, which I think is interesting, if you were to ask this question 4 or 5 years ago, part of the answer would be, lack of a comprehensive regime or framework for insolvency, which is to say, given where we are today, I don't think we're very far off from a period where you start seeing a developing, whether it's international or local entities, in due course with right regulations in place, engaging more and more in this activity.
Yeah, and I think we will.
If you could give me a second, I'm sorry to interrupt you, but I would like to remind the audience that you can post your questions at the Q&A, and we will answer them at the end. I'm so sorry to interrupt. You can continue.
No problem. So we will come back to this issue of non-performing loans. I mean, I think generally it's a, we work in various jurisdictions across the Gulf, and yeah, it's one of those areas that probably needs some guidance from the regulators as to and whether or not the regulators want that, want entities other than banks or licensed financial institutions purchasing these non-performing loans, because there's always this idea that the acquirers of non-performing loans are vulture funds, they're aggressive, they don't care about the borrower. So there's an element you have to balance that as well. Balance that against, would it be more beneficial to the banks to dispose of these loans, maybe at a discount, but hive them off to someone else who's, has the time and the not necessarily the expertise, because that's within the bank, but I guess banks, what do? They lend money. They're not necessarily in the business of working out bad loans, and so if they can be moved off the balance sheet to someone else who is in that business, maybe that enables the bank to concentrate on its core business, which is of course lending. The next thing we want to talk about that we see quite often, and this is, I would say this is a little bit unique to the Middle East, and that is when we're working with a debtor that has multiple banking relationships. So it may have 7, 8, 9, 10, bilateral loans with different lenders, different banks, but there's no intercreditor agreement. So what that means is then when we get to the point where the debtor is in a distressed situation, all of these, there's no document which governs the relationship between these lenders, and related to that, within the bankruptcy law, there's no specific mechanism to cram down secured creditors, and no mechanism to discharge debt. And for the latter two, there's obviously good reasons why that's not the case, because you don't, in particular for secured creditors, if you've lent money against security, that's sacrosanct. So you don't really want that to be interfered with. And likewise, discharging debt. I mean, if I've lent money, I don't want that to be unilaterally discharged. But we want to touch on these 2 points. So no intercreditor, and also the inability to cram down secured creditors, no mechanism to discharge debt. So, I mean, Zaid, maybe we can just talk a little bit, and I've kind of touched on it, but some of the practical issues that you face if you're dealing with multiple creditors or multiple banks, but no intercreditor agreement.
Yeah, I mean, probably the best way to describe it, if you forgive me, would be using the expression herding cats, or trying to gather cats. So as Mike mentioned, it's common, or at least not unusual in other jurisdictions, to have these intercreditor agreements, which would be entered into between various credit providers or lenders to a particular company at the time. In other words, prior to the onset of any financial difficulties. And as much as possible, these parties try and anticipate if, let's say, the clouds do come, and if the company does go through financial distress, as between them, who has priority, and various other related provisions that obviously would fit within the bankruptcy framework in the relevant jurisdiction. In the absence of that, it becomes very difficult and unwieldy to deal with multiple creditors. So as you know, today there are 13 banks in Saudi Arabia. Tomorrow there'll be 12. And you sometimes find, as we do, dealing with, for example, a debtor that has received facilities from 10 or 11 banks, and each one of them has its own terms, and there's absolutely no kind of common document that connects these. It becomes very difficult negotiating and putting a deal through. Again, I would expect that over the course of time, you start seeing these sorts of agreements coming to play. It takes a while, obviously, for these things to develop, and sometimes it's organic, sometimes a particular event leads to that. But I wouldn't be surprised we have this conversation, 4 or 5 years down the line, that you start seeing more and more of these arrangements in the kingdom.
Okay, now thanks, Zaid. And John, again, briefly, I'll just get you to touch on intercreditors and your experience with them in the US, but I also wanted to ask you a broader question about secured creditors, and in particular how secured creditors are dealt with, under Chapter 11. And we sometimes we make reference to Chapter 11 in the US because the FRP process has some similarities. So when we speak with John, we're talking, okay, John, Saudi's obviously a completely different jurisdiction to the US, and as John alluded to at the beginning, there may be some experience we can take from the US to help us better implement the law in Saudi. And one of them that I wanted to talk to you about, and we're going to develop this when we get to future developments, is around discharge of debt, cramming down secured creditors, and how that might be achieved. And I think, John, I'd just like you to talk about what we sometimes refer to as Section 363 sales under Chapter 11. So maybe just explain what that is and how that process can, result in, a better outcome for all stakeholders.
Thanks, Mike. Your and Zaid's point about intercreditor agreements is a good one, because those agreements provide a lot more predictability. They tell which tranche of creditors gets paid first and who gets out fastest, who gets to exercise particular rights. And that makes the process more efficient, because the senior lenders who are fully protected don't need to spend as much time and money safeguarding their interests as what we call the fulcrum creditor, or the creditor that's on the edge or the pivot of recovery, the one who will achieve more or less depending on the outcome of the case. Creditors who are clearly out of the money, they are so junior they have no hope of recovery, they don't have to spend a whole lot of time working on the bankruptcy case to achieve the best outcome. They're never going to get paid anyway. The creditors who are so fully secured that they don't really have to, that they're going to get paid in any circumstance, any reasonable circumstance, they don't have to spend too much either. And so intercreditor agreements are an efficiency mechanism for helping determine who has to put the work into maximizing the debtor's assets. Now, a sale in bankruptcy is one way we maximize the debtor's assets. Bankruptcy cases are expensive and they're unpredictable at times. Value erodes when a company is in bankruptcy, and judges sometimes refer to a bankrupt company as a melting ice cube. It can sometimes take many months to get creditors on board with a proposal and then get court approval for a reorganization proposal and then implement the proposal. The sale of assets, free and clear of prior security interests, is a good way to monetize the debtor's assets and can often be done quickly. Typically in the United States, under what we call Section 363, that's a portion of our bankruptcy code, that process can happen in as little as 30 days, though it's typically 45 to 90 days, depending on the assets that are being sold. This is consistent with Article 5C of the Kingdom's bankruptcy law, which says that one of the goals of the bankruptcy process is to maximize the value of the assets. The method we use in bankruptcy depends on the asset being sold. Oftentimes, the business assets are sold as a complete package to a strategic buyer, or sometimes the senior lender will purchase the company to hold it long enough to achieve a better return or wait for the market to get better. Sometimes maximizing asset values requires a lengthy exposure to the market. Sometimes it can be 3, 4 or months or longer. But sometimes the cost of marketing is so high that it is better to cut the process short and sell it at a lower price. And so, as Mike said earlier, a good law is flexible enough to address these different scenarios. A bankruptcy sale is usually a two-step process. First, the bankruptcy court sets the rules for marketing and selling the asset. It enters an order setting rules for submitting bids and for conducting an auction. If there is a lead bidder who has spent the money at conducting due diligence and negotiating a final sale contract subject to court approval, then that bidder may be given protections, such as reimbursement of his expenses in the event he is outbid by someone else. The auction is held, and the debtor assesses what the highest and best offer is, then proposes to the court approval of that top bid. The second step in the process is the court approval of the sale to the winning bidder. Once the sale is complete, the secured creditor's security interest in that collateral package that is being sold becomes cut off, and the security interest that the creditor had is transferred to the sale proceeds. This can be done even over the objection of a secured creditor, because when we give the secured creditor a right to the pile of money that is created by the sale of the assets, that creditor is getting the benefit of its bargain, the value of its collateral. This is consistent with KSA Bankruptcy Article 75, subsection 4, which allows a Saudi court to amend a security interest where necessary to implement a proposal, provided that the creditor gets a guarantee equivalent to its original guarantee. So that's how we may be able to treat bankruptcy sales with secured collateral in both Saudi and American cases.
Yeah, thanks, John. And we'll talk a little bit about this later on, but it's just something to think about, because at the moment we don't see a whole lot of, if you like, M&A out of FRPs. So, you know, the basic premise with an FRP is that if a debtor enters FRP, the idea is that that entity survives as a going concern, not that the good part of it is sold and the bad part is left behind. So that's obviously intentional, and we're not saying whether that's right or wrong. We're just observing that, you know, there are other ways to deal with a distressed business, and, you know, one of them is obviously to sell the piece, which is still in good shape, and that will obviously entail, you know, leaving behind excessive debt. Turning next, the next one we want to talk about, which always raises issues, is who is a creditor and who is a secure creditor in particular. And Zaid, I think we can attack both of these questions. So maybe we start with who is a creditor and just one or two of the situations we've been in where you know, we would have thought that someone with a contingent claim or someone who was owed commission should be deemed to be a creditor, but sometimes we find that's not the case. And then maybe just talk a little bit about some scenarios where, you know, identifying who is not a secured creditor is important.
Oh, thanks, Mike. Happy to do that. So as Mike mentioned, you know, while on its face, the question of who is or isn't a creditor, you know, would appear to be straightforward, right? So you have to have a debt that's owed by the debtor. Over the course of the past couple of years, you know, we've seen various instances where maybe the position was less clear, or at least was less clear to the courts or the trustees handling these issues. So, by way of example, you know, what do you do with contingent creditors?
And Zaid, maybe just talk, just so we're all on the same. I mean, that's a common term to us, but just explain what a contingent creditor is as well.
Sure, and I was just about to say, you know, when we talk about contingent creditors, you have creditors who are, let's say, more contingent than others. And as a good example of who is a contingent creditor, for example, we could think of a guarantor, where there's a possibility of a debt arising, but that would only happen after a certain trigger event occurs. So in the absence of that triggering event, there's no debt that's owed, but as soon as the event happens, the debt is owed. And one common example, and one that I was going to refer to, would be the letters of guarantee that are issued by banks on behalf of applicants, on behalf of companies. So the bank's liability in relation to, for example, an advance payment letter of guarantee or a performance letter of guarantee, instruments that you regularly see used in the kingdom, say in the construction sector, is contingent. And once a demand is made under that particular instrument, it crystallizes, and then the debt is owed. And so, for example, we are familiar with a case where a claim was made by the beneficiary of a particular instrument on the bank. The beneficiary was not aware that the applicant, in relation, that had basically asked the bank to issue this instrument, was going through an FRP. On the back of that, i.e., as a result of this, the bank chose not to, or decided not to make payments. They decided to follow the moratorium, and they informed the beneficiary that they can't make payment due to the moratorium in place. And this obviously is before December of last year, and we'll talk about the significance of that date later on, once SAMA issued guidance on this particular point. But the bottom line in that particular instance, you had the beneficiary of that instrument filing a claim against the debtor, and you also had the bank filing a claim against the debtor at the same time. So you had a duplication there, and I must say it was very challenging for the trustee. How do you deal with a scenario like this? And again, we've mentioned there's this idea of contingent liabilities. In this particular instance, as is apparent, this contingent nature of the liability is less contingent than could be in other scenarios. And I won't spend too much time on this, other than to say that as you would expect in other jurisdictions, including, say, the US, over the course of years and decades, the system learns to deal with these things, and coming up with a way of estimating contingent liabilities, maybe for particular purposes, whether it's voting or otherwise. But as Mike mentioned, we're pointing out in this context things that we're seeing, and sometimes we may have a solution, sometimes we may propose ideas, and other times we're simply observing. And I'm sure in due course there'll be solutions, and ideally consistent ones. And another example is instances we've seen where commission, so this would be in the context of conventional facilities, but conventional facilities referring to commission, where at least the practice, I would say, by and large in the kingdom is for commission to at least be respected by the SAMA committee, when if there are disputes. And we've seen these not being accepted by courts as claims that are included. So I'd say somewhat ad hoc, but at least enough, I think, that it's worth mentioning.
Yeah, and that's great. And then on the secured creditor point, Zaid, I think you can just spend 30 seconds just maybe identifying the issue, just how the provision is worded, and some of the experience we've had, and then we can touch on it when we get to future developments in more detail.
Sure. So very briefly, the concept of being a secured creditor is a very important one under the bankruptcy law, and that's because there are various, I'd say, perks or benefits or protections that are afforded to a secured creditor. And by way of example, I'd refer to Article 196 that sets out the order of payment of creditors in the context of liquidations. And first in line after the costs and expenses of the liquidation is a secured creditor. So what is a secured creditor? Very important question. We've seen different interpretations and applications our view, and we can talk a little bit more about this later, and perhaps there'll be a question or two about this. The law, sorry, I'll just spend another 20 seconds on this because I think it's a very important point. The law, let's bear in mind that the law came into effect in August 2018. Subsequent to that, you had an overhaul of the laws relating to taking security. And on the basis of this, at least my view is that if you have, and I'll use the Arabic term, haq aini, a right security interest in REM or in a particular asset, you ought to be a secured creditor. And we're very happy to entertain more questions on this in detail later on.
Thanks, Zaid. And then just to finish up quickly, I mean, a number of the FRPs we're dealing with, there are literally thousands of creditors, you know, sometimes up to 3,000 or 4,000. And we just make the note here that the voting thresholds, so going back to basics, every restructuring plan needs to be voted on by each class of creditors. What we see in practice, which is a good thing, is that it's 66 2/3 of the value of the claims of those who vote. So if only 20% of the creditors turn up to vote, it's 66 2/3 of those, rather than having to get 66 2/3 of the entire claims. So we think that's helpful. The next trend we want to talk about is lack of liquidity, and I'll just make some observations here quickly. So we do find that a common issue with FRPs is a lack of liquidity, and an obvious statement is that all business plans will rely on liquidity for them to be able to be implemented. But also, when a debtor is in moratorium, it needs cash to survive. And in many instances, debtors are facing, sort of the perfect storm, if you like. So bank accounts are often frozen. Sometimes that's done even pre-FRP. So by the enforcement courts. So you've already got you've got a debtor whose bank accounts are frozen. The receivables may be controlled by the debtor's existing financiers. And then, if you do need liquidity, obviously there's going to be limited sources. So it's either typically coming from existing lenders, or it's coming from the shareholders. And we'll come back to this again because, this is the alternative finance market. So at the moment, who you're going to borrow money from, typically it's going to be from a bank. Obviously there are some financing companies they're probably more involved in things like receivables financing and maybe leasing companies, but we don't have that in Saudi at the moment. Don't have that, what we call the alternative or private credit market. So these are regulated funds which raise money and then lend that money. And regulated, I mean they're regulated by the CMA rather than the central bank. The next one let's just touch on this briefly, Zaid, but it's around Article 181. So maybe we can just highlight the issue and how we've seen companies deal with this.
So at a high level, for those that are familiar with Article 181 of the companies regulations, this requires limited liability companies whose losses exceed 1/2 of the capital to take certain action, namely registering this in the company's register and holding a meeting within 90 days, whereby the shareholders would decide either to support the company or to basically call it quits. There's an interaction between this particular obligation and the companies and the bankruptcy regulations. The bankruptcy regulations, Article 45, basically says that the obligations under this article are suspended while a company is going through an FRP. And very briefly, one of the things that we've seen, Mike has talked about instances where you might have companies that have a lot of debt, and how do you reconcile this with such a scenario? We've seen proposed solutions of converting debt that's owed by the company into equity. In other words, the creditors that are owed money by this company would effectively convert that debt and become shareholders in the company.
Great, thanks, Zaid. The next topic, which we've actually already touched on, and this is so limited distressed M&A. So what we have seen, or what is we've seen distressed buyers. So this is someone who owes money to the bank, has some good assets, and needs to sell those assets in order to repay the bank. So that's a distressed buyer. But there's sort of limited examples of distressed businesses being sold, and generally we would, in an insolvency process, you'd expect those to be sold out of FRP. So I mean, there is liquidation, but we'll talk about maybe why that's not, selling a business out of liquidation may not be appropriate. But so we see distressed buyers selling good assets, but we don't necessarily see distressed businesses being sold. And we'll just finish up on current trends by just speaking a little bit about some of the guidance that's been provided helpfully by the central bank, but also more recently by the Supreme Court, and how that plays into the bankruptcy laws. So Zaid, maybe you can just briefly mention some of that guidance. So I'm sure most people on the call are aware of it, but let people know what's going on there.
Happy to do so. So at a very high level, in February of 2020, actually 2nd of February 2020, the central bank issued a circular to banks, effectively instructing them to work with bankruptcy trustees to allow the trustees to have access to accounts of debtors that are going through a particular procedure, maybe to run those accounts in the context of a liquidation, to respect the moratorium. Again, things that were alluded to in the opening presentation by Mr. Abdullah Anizi from SAMA. So that was in February. In March, towards the end of March, there were protective measures that were introduced by SAMA, as you saw, also by regulators in other jurisdictions. I would say generally in the banking sector, so not specifically on bankruptcy, but obviously with benefits there. And then on the 6th of December, there was another circular issued by SAMA, effectively instructing, we referred to an earlier scenario where, an applicant of a letter of guarantee may be going through a financial reorganization procedure. What's the impact on the beneficiary? Can they still claim that letter of guarantee against the bank? And SAMA instructed banks to honor their obligations under letters of guarantee, notwithstanding any moratorium in place, and effectively confirmed and acknowledged that these are the obligations of the bank under these instruments are standalone obligations, independent of the status of the applicant. And then finally, I would mention very briefly, also December of last year, the General Committee of the Supreme Court in Saudi Arabia also issued guidance and guidelines for the courts on dealing with force majeure and related considerations in the context of all of the kind of related claims due to the pandemic, which is of course very helpful.
Thanks, Zaid. So that completes the current trends. We're now going to speak about future developments. I'm conscious that we've been speaking for a little while, so we'll keep this part a little bit shorter because we can also roll it into the questions that you've asked us. I'm sure some of what we'll talk about will be complemented by the questions that you're asking. So starting with so we can start with talking about the non-performing loan market. We touched on that briefly. So, is there an argument for saying that it would be good to have a secondary market for non-performing loans. And if that was the case, do we need to enable other market participants to come in? And specifically this question, who can purchase loans? There may be an argument to say, well, licensed institutions should be originating the loans. But is there an argument to say that it might be appropriate to enable others to come in and purchase these loans in the secondary market? So that's one question we pose, and we'd be interested for your thoughts on that. The next one around, and this is really all to do with liquidity, is debtor in possession financing. And I've got Zaid, maybe we can just describe what debtor in possession financing is, and what someone who's providing in debtor in possession financing can expect to receive, and what our experience is with that to date.
Yeah, sure. So debtor in possession financing is financing that's extended in the context of let's say an FRP, and it's called debtor in possession is debtor in possession financing because the debtor's management continues to be in possession of and running the show, obviously under the supervision of the bankruptcy trustee. So for any such financing to be extended, such financing would be secured. You need the consent of the court because of the implications of that, and the implications being that you have certain protections and priorities for debtor in possession financing, and that's needed obviously because you need to encourage this sort of lending, right? Otherwise, why would any lender put money into a distressed company? And this sort of financing can, really turn things for the company, give them some more breathing space, give them some working capital to be able to deal with things, and also kind of inspire confidence in their suppliers and contractors. So it is very important. We've seen a lot of interest in this, but as you would expect, it's probably still early days. We haven't seen much activity taking place in such financings.
Yeah, and John, maybe just briefly touch on what your experience is with debtor in possession financing. I think the important point here to note is that the mechanism to provide debtor in possession financing is built into the KSA bankruptcy law. Hasn't been commonly used, but we're early days. But what's your experience in the US?
That's exactly right, Mike. Like Zaid said, the lender is going to want a very high level of protection given the precarious condition of the patient in the hospital. The way that happens is the courts will give the debtor in possession lender or the post-bankruptcy, post-filing lender a senior security interest higher in priority to all other security interests. But that can only happen if there is enough collateral to go around so that no previous secured lender is harmed. If there's not enough value in the debtor's assets to protect the interests of the existing secured lenders, then the court cannot approve the debtor a secured debtor in possession financing over the objection of the previous lien holders. And as Mike alluded to, that is consistent with Article 75 of the KSA bankruptcy law, which permits a court to change the collateral package as long as the lender gets the previous lender gets equivalent security. So there is some flexibility, but unless the prior lender is going to consent, a court cannot force it to accept something where it will end up being out of the money. Oftentimes it is the senior lender or a secured lender who comes in and will substitute its old loan or for a new loan because it's afraid that if the debtor does not get cash to continue operations, it will die and have to liquidate for, small percentage of recovery. So it can work the same way if courts focus on Article 75 and merge that with the secured lending provisions of the KSA law.
Yeah, no, that's helpful, John. Thank you. So the next thing we want to talk about, Zaid, and this is really a question for you that I want to put to you, is who is a secured creditor? I know that, there's, and our experience has shown that, sometimes people think of security as tangible. So let's just say it's over land or shares. But what about, what about other immovable property? And I'm thinking about receivables. I'm thinking about equipment. Those sorts of things. Do we think as a firm that you can take security over those assets? I think the answer is yes. But do you think the holders of that security will be recognized in a bankruptcy as a secured creditor?
I think they should, Mike. So as we mentioned in April of last year, a new law was introduced, the law on securing rights with movable assets. And the existing commercial pledge law, again, which exists in relation to movable assets, was also substantially overhauled. And effectively, the law on securing rights with movable assets is an umbrella law that applies to taking security over movable assets. And I would say two key points. What the law very clearly provides is that subject to perfection, and perfection means, the action that you would take in order for the security interest to be enforceable against third parties, against the rest of the world, and this would either be by registration or possession. You are a secured creditor. Your security interest is good against the rest of the world. And again, we can get caught up sometimes between terms of art that are used maybe inconsistently between different pieces of legislation in Saudi. Again, you have the bankruptcy law that's from 2018. This is legislation now from 2020. But the law very clearly talks about having a security interest that's enforceable against third party as long as you perfect, and specifically refers, Mike, going to your question, to, for example, security over receivables. Again, a very common arrangement in the context of providing financing for projects. So certainly our view would be, so long as the security has been perfected in accordance with the law, and the law very clearly says that this security interest is enforceable against third parties, it must be that this is a secured creditor for purposes of the bankruptcy law.
Yeah, and I think that's our view. I mean, we know that there's been different interpretation in the courts, but from our perspective, if receivables financing, for example, very important way to finance a business these days, anyone who provides that sort of financing needs to know that if they are taking security over those receivables, either through an outright assignment or an assignment by way of security, that's going to stand up in an insolvency. Otherwise, that financier either is not going to lend that money or they are going to charge a much higher rate. So these are just our views. I appreciate that those in the audience have had different experience, and we're going to turn to some of those questions shortly. The distressed M&A, we've already actually largely covered this, but John, just in a couple of minutes, I think I just want to revisit it again, because I think this is an area where obviously the law in Saudi has been set up in this way, and we're not here to say whether that's a good or bad thing, but the FRP process, as we understand it and the way we've seen it being implemented, is that as a general rule, the business that enters FRP exits FRP, so it survives as a going concern. What the FRP doesn't really contemplate, at least not at the moment, and not in our experience, is a business going into FRP readying itself for a disposal, and then effectively the good part being disposed to new equity, or in some cases it might be the same equity, but at least giving the good part of that business a chance to survive. So again, we've touched on this already because you've already spoken about the Section 363 sale, but again, maybe just repeat that because I think it's quite an important one.
Well, as we talked about, the bankruptcy sale can be a quick, efficient way to maximize the value of the debtor's assets. The debtor has the flexibility under the U.S. structure to sell its assets in parts or as a whole. And I talked earlier about selling a business as a whole. That is oftentimes the best way to maximize value. but sometimes selling off certain lines of business independent from the core business works to the debtor and the creditor's advantage. The process that the United States has that is flexible in that you can have a debtor sell off either the underperforming lines and monetize those, and then just stay with its core business, and then reorganize around that core, or it can sell off the crown jewels, so to speak, and then take the remaining assets and either liquidate or, if it's possible, reorganize around those in light of the funds that were recaptured in the sale of the crown jewels. So you have to take a pragmatic approach sometimes, because there are going to be some debtors that have one line of business, some that have multiple. And I think while courts over in the United States have struggled with the idea of how much flexibility do we allow a debtor to have, because that flexibility can effectively swallow up all the protections for creditors built into the plan or proposal process, it is something that we have over here to address different situations.
Yeah, no, and as I say, we've touched on this point before, and it's really for the audience to think about, and whether there's any further debate in that, and whether we think it would be helpful to have the flexibility to be able to sell a business out of FRP, and whether that would be a good or a bad thing. So that's great. Then I'm just going to touch on this. One thing I'm interested in seeing is that, there's a number of provisions in the law around, let's just say, unwinding transactions which have been entered into prior to the onset of insolvency. So the common one is, where assets have been stripped out of the business to be put beyond the reach of creditors. So we'll be interested to see whether any of those powers are exercised by the court, and or creditors for that matter. Now, of course, if you've got a business that has been stripped of its assets and you're wanting to pursue the people who've been involved with that, it costs money. So it may well be that creditors have to put more money into, to recover the money that's disappeared. So that's always going to be a commercial decision whether they do that or not. But interestingly, the bankruptcy, and maybe not interestingly, but it's a good thing, the bankruptcy law does give the courts the power to look at these types of transactions. So transactions at an undervalue, preferences, and the ability to, recoup that, the powers to recoup those assets in certain circumstances. And we're interested to see where that heads. And just finishing up on future developments, Zaid, maybe you could just briefly comment on this. And I think, we've seen one or two instances where, government intervention, the government may come into situations where, there's a strategic asset, and I'm really thinking about some of the large real estate developments, may come in to broker a deal outside of a restructuring plan. And I think for all of us involved in this call, there's work for us in those situations as well. I mean, not every distressed company goes into a restructuring process. There's plenty of out-of-court processes, and of course, that's how most restructurings were done before the bankruptcy law came about. But maybe just touch on that, Zaid, and see if we've come across anything.
Sure. Yeah, the government can and does in fact assist with these situations, and you see this also in other jurisdictions, Mike. So you mentioned maybe at a very basic level, it might be using whatever influence or relationship it has to bring the parties together, the relevant parties, maybe even come up with solutions. In some instances, there could also be financing extended and or flexibility with existing financings. So you do see this, and there is a role for this. I mean, even in jurisdictions with very, very developed frameworks and decades of experience, there sometimes is a role for this sort of intervention.
Yeah, no, you make a great point. I mean, a case in point at the moment is the steel industry in the UK, Liberty Steel, which has been in the press recently because its main financier went bankrupt effectively. It was borrowing money. I think it's Lex Greensill, isn't it? And that financier went out of business. So Liberty Steel, which basically owns a large chunk of the steel industry in the UK, its funding sources have been pulled from it, and they're in talks with the UK government for a bailout. So you're absolutely right. It happens across the world. So great. Okay. So that brings us to the end of the formal panel discussion. And now we're going to just take a look at some of these questions. So Zaid and John, can you see these questions as well?
Yes.
Yeah. So let's just go.
Mike, I'm happy to take the first one since it's in Arabic.
Yes, please go ahead.
Okay. I hope I do address it because it's a general one. The question is هل يوجد دعم من الحكومة السعودية في تعديل وضع المتعثر في شركاته? So is there support provided by the Saudi government in let's say facilitating or assisting entities that are facing financial distress? And I hope that's the right question. You know, we just finished off the presentation with instances where the government might lend a hand or do what it can when you have a project that let's say is too big to fail. And at the other end of the spectrum, and this even predates COVID. You know, the insolvency law was introduced for a reason, right? And that's to, you know, for multiple reasons. But one of the reasons is to ensure that companies that are facing financial distress, that can still kind of play a role in developing the economy, if they can just get past this bump in the road, if you will, that those companies are safe. And outside of the bankruptcy law, we've seen multiple kind of complementary efforts from the government to accomplish the same thing. So, for example, under the Ministry of Finance, there's something called the Sustainability Support Program, and this is a program whereby the ministry would partner up with Saudi banks to extend financing to, again, companies that fulfill certain criteria. And chief among these are, again, it's a company that you know deserves this spark or this kick or this assistance. They're otherwise, of course, unable to get financial assistance, but through this program they can, and that should help them get around the corner. So I think just to finish up, I mean, there's probably multiple such programs. I know probably, you know, maybe someone else could provide more information on this, but the bottom line is, yes, there are lots of programs available and support.
Okay, thanks, Zaid. Next question, I'll answer this one. Why are financial lease companies not allowed to take back their assets once the bankruptcy proceeding has initiated? The assets are in fact owned by the leasing company, who should have access to them at any time, especially in the event of default. Well, look, it's a very good point, and this is where, you know, we have the balancing act between balancing the rights of an owner, in this case, or creditor, and the debtor. So I guess the basic proposition is that if you enter FRP, you're looking to survive as a going concern, and if all creditors could come in this case, the financial lease company is a creditor. I know that they also own the asset, but if they could come in and repossess those assets, then it accelerates the demise of the debtor. So it's really just a public policy reason and the balancing act and the legislation. And so what would typically happen, and what you'd hope to be happening, is if with the financial lease company, if the debtor is no longer making its payments under that, then of course they've defaulted under the contract. But because of the way the moratorium works, you can't go in there and reclaim your assets because of the moratorium. So what you would have to do, you would have to either apply to the court, in particular if you were concerned that the assets were degrading, because either they're not being looked after, or the debtor is not storing them properly or misusing them, you would have to make a specific application to court to get those back. But the simple answer is that the ability to go and recover those assets falls under the moratorium, and the moratorium is aimed at giving the debtor breathing space. And if everyone went in there and took back what they were owed, or what was owned by them, then that would just lead to the demise of the debtor. Okay, Zaid, you got the next one?
Yeah, and the next one I would, if I may, I would just refer to the same answer I gave to the first one. The question is there support from the government for companies that are impacted by Corona? So I know indirectly we've touched on some of these issues in the presentation, but just more generally, yes, there are some programs. Yes, there is some guidance SAMA put out on the 29th of March last year to banks in dealing with their customers that are that are facing some of these difficulties, and probably would stop there.
Yeah, the next one is a good one as well. And the question is, in the event that the business owner has not filed for individual bankruptcy and has only filed for the company's bankruptcy, why are financiers not able to call on the personal guarantee? So a not uncommon position is where you've got a company, and that company is owned by an individual. The company has borrowed money from the bank, and the individual who owns it has given a personal guarantee. And what the law says is that when that company goes into FRP or applies for FRP, and that application is accepted by the court, a moratorium applies. So the moratorium applies not only to the debtor, but also to anyone who's guaranteed the debts of the debtor. So in the situation that's just been described there, the individual business owner, which is the shareholder, is actually also a guarantor. So it's acting in two capacities. It is the owner of the business because it owns 100%, or he or she owns 100% of the shares in the company, but they're also a guarantor, and the moratorium applies not only to the company, but also to guarantors. So hopefully that answers that question.
Mike, and this is John. One other thing to think about with respect to why that helps is because in the case where you've got a business owner who is also the guarantor, it is sometimes very difficult for a company to reorganize when its key executives are having to fend off lawsuits or defend themselves personally. Sometimes that impedes the ability of the debtor's management to do its job and rehabilitate the company. So that is part of the rationale behind why the moratorium statute is written the way it is. Yeah,
and that's helpful, John. And it's also interesting to know that not all jurisdictions follow what Saudi does. So, and the example I just gave, in other jurisdictions. So, for example, if you went to the UK, the company which files for insolvency, that's the debtor, it gets a moratorium. But if the guarantor of that person's debts wants to get a moratorium, it also has to go file for bankruptcy. So it's not all jurisdictions are different.
Yeah, the United States, a court has the ability to extend that moratorium without the guarantor filing bankruptcy. So different places like do it differently.
Yeah, interesting. Okay, Zaid, I think the next three are for you, actually.
Sure. Okay, I'll try and run through these quickly. I'll read it quickly in Arabic and then in English, just so it's clear to all. لكي يستمر المتعثر في السداد، هل يتوجب على البنوك تقديم بعض التسهيلات في السداد أو التنازل عن جزء من المبالغ لكي يتمكن من الاستمرار في نشاطه الاقتصادي? And I hope I've got the question right. The question is providing, in order for a distressed company to be able to continue in its economic activities, are banks required to provide some facilities or to forego or waive some of the amounts that are payable to them? And I mean, if the question is, are they required by law to do so? No, there are certain instances where banks or creditors may be crammed down. In other words, there's obviously a proposal that's put to voting, and if the necessary amount of creditors vote, a certain creditor may be forced to give up part of the claim. In other words, they may not be repaid there. And then there are other calculations, whether a bank decides to forego some claims or to extend, we talked about considerations relating to debtor in possession financing. So there's certainly other angles to this, and lots to talk about. The next question, please forgive me, it's not entirely clear to me. The question is, ما المقصود بقيام البنوك بشراء المدفوعات العينية؟ هل المقصود التنفيذ على الضمانات؟ I apologize, I haven't heard before شراء المدفوعات العينية. If anyone would like to clarify that, please do, but I can't answer it because I don't know what that means. I haven't seen that. I've seen the words, but not put together before like that. So it's unclear to me what that means. And maybe that's why the person that asked was also confused by it. So we'll go to the next one. And if anyone would like to clarify this, please do. The next question was, ما هو آخر إجراء لكي تتفادى الوقوع في الإفلاس? The question is, what's the last procedure that could be taken in order to avoid liquidation? I mean, maybe I'd mention a couple of things here. Hopefully this is a helpful response. Bear in mind that for liquidation, the application to commence the procedure could be commenced by either the debtor or the creditor, so you're not always in control. Bear in mind that if the creditor is going to initiate this procedure and their application is going to be accepted, they have to have a fixed debt that's uncontested. So there's also ways from a debtor's perspective to kind of address that. And then ultimately, the best way to avoid this is with sound financial management. That doesn't always work out that way.
Great. Next question, how is debt reprofiling different to debt restructuring? Well, I mean, look, I think the terms are broadly interchangeable. Reprofiling, I would say, is that the amount of the debt stays the same, but the time period within which you pay it is extended. Debt restructuring, you may say, well, that you're going to take a haircut, but reprofiling, restructuring, I think the terms can be used interchangeably. The way I used them in this presentation was, though, reprofiling was extending the term of a facility. So instead of having to pay the 100 back in 5 years' time, you can pay it back in 10. Restructuring, you might say, is instead of paying the 100 back in 5 years' time, we agree that I can pay 50 back in 5 years' time. So that's taking a haircut. Turning to the next question, this is around administrators, and I'm assuming this is maybe a reference to bankruptcy trustees and whether or not, if either a debtor or a creditor is not, wants to replace a bankruptcy trustee, is there a mechanism to do that? And I think broadly speaking, yes, there is. You would have to apply to the court. All bankruptcy trustees are vetted by the committee, and they're on a designated list. So every bankruptcy trustee will have to pass a certain threshold before it's put on the list of bankruptcy trustees. But there is a mechanism to change the bankruptcy trustee if you're not happy. And quite often, the way we see things work, and it's not always the most efficient, but quite often we see a bankruptcy trustee who's been appointed, but the debtor also appoints its own advisors. So, for example, they might appoint someone from the Big Four or some other advisory firm, and the advisors to the debtor and the bankruptcy trustee kind of work together, which is the way it should be. So because many of the bankruptcy trustees, they may not necessarily have the resources. Some of them are, smallish accounting firms. Maybe there's only one or two practitioners at the bankruptcy trustees. So, they quite often they are working with the advisors of the debtor as well. Zay, do you want to take the next one? We've touched on this already.
Sure. Yeah, happy to do so. So this question is in relation to, again, what's recognized as security for purposes of the bankruptcy law. Specifically, one thing we talked about, which is the assignment of proceeds or receivables, which, as the question intimates, is a very common practice in financings for projects in Saudi. And you know, as I mentioned, I think, again, to my mind or our mind, based on the legislation, including the legislation that was issued last year, the law on securing rights with movable assets, which, you know, clearly kind of sets out the framework for, you know, enforceability of security interests vis-a-vis the grantor of the secured interest and third parties. So the law very clearly, for example, says that, you know, if you don't perfect, i.e. if you don't register your security interest, or if you don't possess, in some cases, possession of the collateral is required, if you're in that space, then your interest is good as against the grantor, but not the rest of the world. But once you perfect, once you go through the relevant procedures, your security interest is enforceable against all third parties. And again, to my mind, I mean, that surely must mean that, in, for example, Article 196, you're at the top of that waterfall, because your interest is valid against third parties. And again, just so there's no confusion over this, that you're good against the rest of the world in terms of your interest in that particular asset, right? So you're secured and ahead of everyone else to the extent of, you know, what you can recover from that asset. Once that asset is extinguished, for example, you've been paid and maybe that only covers 50% of your debt, then for the balance you're unsecured. Okay, sorry, Mike. The next one was the next one also in, okay, the next one is in Arabic. Yeah, okay. لدينا في المملكة نظام ضمان الحقوق بالأموال المنقولة ونظام الرهن العقاري، وهذه الأنظمة تضمن للدائن الراهن بعض ممتلكات المدين في حالة تخلف عن سداد الدين وتعثره، وبالتالي يكون الدائن الأولي في. Okay, so I think you know, this question is referring to the legislation that we've just discussed in relation to taking security, and also refers to priority that's granted to the beneficiaries of these security interests. Yes, I mean, I think my sense was maybe this is a statement rather than a question, but hopefully we're in agreement, and the clarification that we provided about the rationale for, you know, who is and isn't a secured creditor is helpful.
Yeah, that's great. And we just had a question about the NPL market. How could we get that started? I think, yeah, I mean, look, for you know, to be buying a non-performing loan, any purchaser of that loan will want to see a way out. So what is a way out? Either they buy that at a discount and just wait to be repaid, and hopefully they get, you know, repaid more than what is owed, or they may want to work that loan out. So that may involve enforcing security. It may involve putting the debtor through an insolvency process, and that enforcing security and working through an insolvency process, probably, you know, as Zaid mentioned in the presentation, maybe 5-6 years ago, you know, those tools weren't available. They are available now. So in theory, you know, those who are interested in buying non-performing loans, the tools at least are available. Obviously they're new tools, we're still learning how to use them. But they are available. And I think the other thing that we probably do need some guidance on is, you know, as a fund, a CMA fund, say, for example, you set up a CMA fund, CMA approves your offering circular, you raise money. Is that sufficient for that fund then to be able to go out and acquire loans? And, you know, our experience is that, you know, that's still not 100% black and white. That, you know, who can originate loans, who can own loans? Is that only someone who has a central bank license, or is that someone else? So I think many of the issues around the non-performing loan market have been addressed through new bankruptcy laws, new laws around taking security, but the regulatory piece, we probably need a bit more guidance on that.
Okay, and the next one, Mike, the question is, sorry, it just jumped up. Let me go back to it. كيف يكون للدائن المضمون حق عيني؟ كيف يتم ذلك? The question is, how does a creditor obtain a security interest in REM? How is that accomplished? And I think the best way to think about this is just to follow through the requirements for obtaining such a security interest under the law on securing rights with movable assets. The law specifically refers to a secured interest as an interest granting, quote unquote, it's a term of art, حق عيني, or an interest in REM, in the specific asset. And there are various conditions, and we've also discussed the kind of perfection mechanics. And on behalf of also the team, we reiterate for any of these questions, if you'd like kind of more in-depth discussion afterwards, we're very happy to do that.
Okay, so we'll go down to this one, Zaid, where I've got my...
The one after that, 608. نظام الأموال المنقولة أعطى أولوية للمدين للتنفيذ على الأموال المضمونة عن طريق المحكمة المختصة. Yeah, so this is again a statement rather than a question, that the law on securing rights of movable assets grants the المدين. Actually, I think they got it right, but it grants the creditor the right to and priority to proceed against the secured asset. So statement, yes, we agree.
And the 614.
614. هل يعتبر دين الدائن عادة بنوك الذي لديه تنازلات عن عوائد عقود المدين دين مضمون ضمانا عينيا في ظل أن عدد من ملاك الشريعة يكون لهم الحق في تحويل عوائد المشروع المتنازل عنه من المدين لصالح دائنين آخرين بخلاف البنك المتنازل له؟ Okay, sorry, I probably didn't get all the way through the question, but it seems to be asking a similar question. And again, this just reflects that this is an issue that, you know, we're really seeing across multiple cases, and it refers to the assignment of receivables and whether or not this would be considered security for purposes of the bankruptcy law. And what I would say, I would just refer generally, and you know, this may be a little bit mechanical and working through some of the priority rights, but very generally, I would say the law says that when notice is provided to the third-party obligor, that, you know, the party that's basically paying the receivables or the contract proceeds, when the debtor or the assigner provides notice to that entity, then the security interest is good against that entity. Once you register, the security interest is good against the rest of the world. And then you need to work through, because this question also goes through assignments relating to these arrangements, you just need to make sure that in the context of those assignments, these rules of priority are respected.
The next question, what happens to amounts collected by an agent of receivables if such agent goes bankrupt? Well, that is a very good question. I think the general proposition is that these receivables are not the property of the agent. That's what you would be arguing.
Yeah.
Those receivables are the property of whoever the agent's collecting those receivables on behalf of. So what you wouldn't want to happen is for that property to be deemed to be property of the agent. Say, do you have a view on that?
I think that's exactly right, Mike. And then all the more, you know, that's why you have considerations about who does or doesn't act as an agent, and whether this agent is under regulatory duties to, you know, segregate assets, what is owned by them, what is owned on behalf of third parties. But yeah, I agree with the analysis.
Yeah, but it's a really interesting point, because that, you know, you would have some interesting arguments if that did occur.
And Mike, the one thing to think about is that, of course, in a FRP under Article 59, the trustee or office holder has a right to obtain information from the debtor, and then under other provisions has to publish information about the debtor's assets. So if you believe that your agent has gone bankrupt, it would be incumbent to monitor the filings by the office holder very carefully to see what the office holder contends are the assets of the debtor. Because as you say, the debtor should have no greater rights inside bankruptcy to property than it had immediately before bankruptcy. Its property is what its property is, and that may not include the full rights to those receivables if it's just a collection agent.
Yeah, no, good point. Say we've got a 620, and I think the questions 8 is, and it's really just a, why do companies have to publicize the fact that their losses have exceeded more than 50% of their capital? And I guess it's in very simple terms, it's a health warning, isn't it? That the company might not be doing so well.
Exactly, absolutely. So it's putting the rest of the world on notice, somebody that may not otherwise be aware of the financial difficulties that this company is going through, and if they were aware, would they choose to deal with them? And I mean, maybe the question is also going to whether it makes sense to have the 50% of the capital as the trigger, but again, sometimes you have to draw the line somewhere, and that's where it's drawn.
Yeah.
Okay. Well, I'll see if there's anyone that would be interesting for you, and John, I'll just translate it. ما هي الطرق المناسبة لحماية النشاط، وما هي الآثار القانونية المترتبة على افتتاح الإجراء? Okay, Mike, I'll just translate it for you. What are the appropriate ways of protecting the activities, presumably of a company, and what are the legal ramifications of commencing a procedure? Or, I mean, if you want, I can address it, but just to involve.
Yeah, no, I think you better address that one. Okay.
So, I mean, in terms of the procedures to protect the activities of a company, I mean, this really is a general question, right? There are all sorts of governance considerations, good practice, but it doesn't mean that sometimes companies that are doing things right don't end up in a difficult situation, maybe because of a pandemic. I mean, there are lots of reasons why you can see sometimes particular industries are hit. So it's not always possible to insulate activities or a company from some of these challenges, and that's precisely why it is important to have something like the insolvency law that provides protection and save companies that should be saved. Okay, and the one after is هل يجوز تسهيل خطابات الضمان أثناء مدة تعليق المطالبات، وما هي السبل النظامية للوقاية من تعسف الدائن في تسهيل الضمان وتقديم دائن على دائن? So the question is it possible to liquidate letters of guarantee during the moratorium, and what are the regulatory procedures to prevent a creditor from liquidating a letter of guarantee and thereby getting an advantage over other creditors? Mike, I'm happy to answer it unless you.
Yeah, I can answer that. So look, I think the basic answer is that there's now nothing stopping the beneficiary of a letter of credit liquidating that, and I think there needs to be a distinction made between maybe letters of credit and other guarantees. I mean, letters of credit, I mean, the sole purpose really of getting a letter of credit issued in your favor is to cover the situation where the person who's supposed to pay you the money becomes insolvent. So I'm just seeing, I think that's all. I mean, or one or two others, but I think we've covered most of them now. So back to, so look, I think that was a great session. We're very thrilled that so many people stayed on, and all these excellent questions, because I think the more questions we ask, I was always told the only stupid question is the one you didn't answer or didn't ask. So, and particularly with something that's new, I think the more questions we can ask, the better. And with implementing any new law, there's going to be some good parts and bad parts, and our job really as market participants is to, we want to make sure this law works as best as possible for Saudi, and what we hope to achieve today is just to provide some ideas. Some of them you might think are terrible, some of you might think are good. But where we, if we can build some ideas, some good ones, and build a bit of momentum behind them, and then we can go and speak to people like at the committee who are very open-minded, the central bank, and there may be ways we can tweak and change the law to make it better for everyone. So we thank the committee, we thank the central bank, we thank the audience. Zaid and John, thanks obviously for participating, and I'll hand back to the committee. Thank you very much.
Yeah. Thank you so much, Mr. Michael, Mr. Jonathan, and Mr. Zaid. You've answered over 40 questions. That's very impressive, and I'd like to thank you for that. We also would like to thank our friends at the Saudi Central Bank for their cooperation. In case your questions weren't answered, you can visit Contact Us page and send us your questions there, and we'll try to help you there. Thank you so much for attending the symposium, and thank you so much to our partners at King & Spalding.
No, that's fine. And also any of the questions that aren't answered, please send them to the committee, and committee, please feel free to forward them on to us as well. We'll be delighted to answer them.
Yes, thank you so much for that.
Wonderful.
Yeah, thank you for attending the symposium, and goodbye.
Okay, thank you. Bye.
Thank you.